Welcome back to episode 3 of the Unconstrained podcast with your hosts, James Cawley,
And Drew Girouard.
where each week we break down one major topic for our listeners to better equip them in client conversations and candid interactions with their peers. Drew, it's great to be back. In the studio this week, we've got a less headline-driven topic. We're talking about direct indexing, what that looks like, what it might mean for a client, who it might be right for, and what the actual strategy looks like when we're putting rubber to road. So, Drew, how you been? We've taken a short break from our last episode, but we're back and firing on all cylinders.
I'm doing good on my end. We're rolling into the holiday season, which is a great time of the year. So definitely happy on. And yeah,
The holiday cheer is here. Let's dive right in. All right, so Drew, first question for you. What I want you to break down. A direct indexing strategy is it's ultimately gonna be a separately managed account as far as the account setup goes on our end. So break down what a separately managed account actually is and how direct indexing fits into that definition.
yeah. So think of an ETF sort of as a basket of stocks. So you own a share of the ETF that then allows you to get access to all the stocks within that basket and you get exposure that way. With the SMA, you're actually buying, like you said, each individual ticker within the index or a good majority of them to get the factors that drive the performance of the index.
So it's almost the reverse intuition to an ETF. I'm buying into an ETF to get broad exposure, whereas with the direct indexing strategy, you're buying each individual position to have that direct exposure. Is that fair to say?
Yeah, that's fair to say. They both are essentially trying to achieve the same thing, which would be minimize tracking error against the index that they're meant to track. So, for instance, the S&P 500, you would try to buy each individual stock of the S&P 500 or a basket that mimics the factors with the SMA in the direct index versus the ETF, which would essentially do the same thing, but then wrap it all together and sell you one single unit rather
I,
than the entire thing.
I got you. So if the intention isn't to outpace the index, the intention is to mirror the index as closely as possible. What is the purpose of direct indexing and who is it right for on the client side?
Yeah, so the purpose of direct indexing is it definitely gives the investor a lot more flexibility between tax loss harvesting. So if the index itself goes up, an ETF doesn't give you any options to pull any tax losses. However, the constituents of the index don't necessarily all have to be going up all at once to drive the index higher. So that gives you the flexibility within the SMA to harvest some of those losses while still maintaining the similar performance as you would to the ETF or the index itself.
I got you. So a client who's maybe looking to gift a brokerage account later on in life, maybe a client who's looking at a net tax performance on their accounts, a client who's got very healthy cash flow and is building up a large brokerage account, maybe early on. Are these all client profiles that might fit that direct indexing strategy?
Yeah, any instance where after-tax return is very important to an investor is where a direct index is definitely the most useful. So, for instance, if we have a dentist that's looking to sell their practice in 10 to 15 years, you know that they're going to have that big liquidity event that's going to carry some large capital gains. They can try to start offsetting those gains using the direct indexing approach to make that one-time tax bill hopefully a little more manageable in the future, while still staying fully invested.
So, Drew, I know there are some account minimums in place, and from the servicing side, having set up a couple of these accounts, I believe 250,000 is the minimum in place through Cetera's My Advice Architect platform with a few of the providers that we've used. I know Parametric has been the manager that we've used for the accounts that we've set up in the past. And there's some conversation going on right now back and forth with Cetera as far as flexibility for that minimum. We're trying to get 200,000 as an acceptable account setup amount. So that's ongoing right now. But as far as that initial investment goes, are clients going to need 250,000 sitting in cash on the sidelines if they already have a brokerage account with, say a large SPY position worth 150,000? Is that something they're going to be able to to fund these accounts with?
Yeah, so from the index provider's perspective, that definitely is the case. We're still looking for a little bit of clarity on Cetera's side, whether or not we'd be able to use some of those positions like SPY, or say the client has a large Apple position. You could use that to help create some of the exposure in the index and maybe not have to hit that threshold. We're still waiting on 100% certainty on that, but I did actually just get off the phone with Russell, and they have a $100,000 minimum on their large cap value, large cap growth, and S&P 500 direct indexes. So there are going to be some use cases for some of those smaller accounts.
I got you. And for the listener here to add some additional context. So if a client's looking to engage in a direct indexing strategy, we are partnering with a separate manager, whether that be Russell, Parametric, through the My Advice Architect platform to build out that direct indexing account. And then, Drew, correct me if I'm wrong here, but that manager is the one that's actually trading the account on an ongoing basis, harvesting those losses. So it should be noted that there is an additional fee that comes with this direct indexing account setup that covers that manager fee. It does differ from manager to manager, so Parametric isn't going to be the same as Russell, and that's an ongoing conversation as well. But it's important to note that we are including a third party here with the client accounts that are going to assist in that ongoing direct indexing strategy. Anything on the account setup side, clients this might be right for that you think we left on the table, Drew?
Yeah, I would say definitely clients that have a long time horizon with their money. If you're going to be withdrawing, or if they're going to be withdrawing money from it within like the next 5, 10 years, it probably doesn't make as much sense because they're not going to get as much tax benefit as they would if they were to hold it and then give their kids stepped up cost basis. So that's a big thing to look at because it's not as easy to get rid of as the S&P 500 ETF would be because you are holding each individual ticker or a good majority of them. So it's going to make statements look a little messy, and unwinding it isn't going to be as easy as just selling the individual SPY or VOO ticker. So that's definitely something to be aware of as well.
I got you. It's an important conversation to have with the client up front about the intention and timeline for that account. Now, Drew, I know at the beginning we said we weren't going to dive into any headline news here, but something I do want to hit on, fixed income and its presence, in a dropping rate environment. We saw a rate cut last week from the Fed. Give me some quick thoughts on if you have a large money market position built up, is it now time to start looking at, okay, as rates are coming down, is this money best employed elsewhere? What are PRC's thoughts on the fixed income space right now?
Yeah, so we think rates coming down on the money market account definitely gives a good reason to look at some of these larger cash positions to see if they're investments or if it's just a placeholder for an expense that you know is coming within the year. If it is an expense that you know is going to have a big withdrawal, then it probably makes sense to keep it in the Vanguard money market account. But if this is an investment account and you know the client's not going to use the money for 3, 4, 5 years, then we would definitely recommend trying to switch into something like a PIMCO income fund. I don't think that we're poised to get another double-digit year on the PIMCO income fund, but the starting yield is in the upper sixes to lower sevens, and I think that that's a good place to benchmark to, and it's definitely possible that we get that as a return. And if we do get the long end coming down, you could end up seeing double-digit returns again. So we would definitely say that one of the best relative values in the market right now is going to be in the fixed income area. So it's definitely worth looking at clients' portfolios and seeing why they have the cash.
Absolutely. All right, Drew. I think that brings us to a close for episode 3 of the Unconstrained podcast. We want to wish a happy and healthy holiday to all of our listeners. We appreciate all of you out there. And again, we're always looking for input and episode topics that our listeners are looking to have covered. Some new exciting updates for the new year. We're going to be on a more consistent release schedule, so keep an eye out for Unconstrained in your inbox, and maybe we'll even have a couple guest mics for future episodes. So looking forward to that. Drew, anything else?
That's all from me. Have a happy holiday, and thank you all for listening.